The Engulfing Bar Candlestick Pattern.
A bearish engulfing pattern is a technical chart pattern that signals lower prices to come. That consists of up candlesticks, followed by a large down candlestick that engulfs the smaller up candle. The bearish engulfing pattern candlestick pattern gives us valuable information about bulls and bears in the market. This pattern shows sellers have overtaken the buyers and are pushing the price more aggressively down than the buyers were able to push it up candle. When this price action pattern occurs in an uptrend, we can expect a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down. Trading any bearish candlestick pattern that you find on your chart is not possible. You will need other technical tools to confirm your entries. The bullish engulfing bar pattern. A bullish engulfing pattern is a candlestick chart pattern that forms when a small black candlestick is followed the next day by a large white candlestick, the body of which completely overlaps or engulfs the body of the previous day's candlestick. The bullish engulfing bar pattern shows us that the market is no longer under the control of sellers, and buyers will take control of the market. Bullish engulfing patterns are more likely to signal reversals when they are preceded by 4 or more black candlesticks. Investors should look not only to the 2 candlesticks which form the bullish engulfing pattern but also to the preceding candlesticks. Bullish engulfing patterns are more likely to signal reversals when they are preceded by 4 or more black candlesticks. A bullish engulfing pattern can be identified when a small black candlestick, showing a bearish trend, is followed the next day by a large white candlestick, showing a bullish trend, the body of which completely overlaps or engulfs the body of the previous day's candlestick. The Doji candlestick pattern. A doji candlestick forms when a security's open and close are virtually equal for the given time period and generally signals a reversal pattern for technical analysts. Doji is one of the most important Japanese candlestick patterns. A doji is a name for a session in which the candlestick for security has an open and close that are virtually equal and are often components in patterns. They are neutral patterns that are also featured in a number of important patterns. The formation of doji comes in 3 major types: gravestone, long-legged, and dragonfly. The chart above shows how the market changed direction after the formation of the doji candlestick. The market was trending up, which means that buyers were in control of the market. A doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves higher or lower. When it is found at the bottom or at the top of a trend, it is considered as a sign that a previous trend is losing its strengths. The Dragonfly Doji pattern. A Dragonfly Doji is a type of candlestick pattern that can signal a potential reversal in price to the downside or upside, depending on past price action. Dragonfly Doji formed when the asset's high open and close prices are the same. The long lower shadow suggests that there was aggressive selling during the period of the candle. Since the price closed near the open, it shows that buyers were able to absorb the selling and push the price back up. The appearance of a Dragonfly Doji after a price advance warns of a potential price decline. A move lower on the next candle provides confirmation. A Dragonfly Doji form after a price rise or a price decline. The open, high, and close prices match each other, and the low of the period is significantly lower than the former 3. This creates a T-shape. In the chart above, the market was testing the previous support level that caused a strong rejection from this area. The Gravestone Doji. A Gravestone Doji is a bearish pattern that suggests a reversal followed by a downtrend in the price action. This pattern can be used as a sign to take profits on a bullish position or enter a bearish trade. The opposite of a Gravestone Doji is a Dragonfly Doji. What differentiates the Gravestone Doji from the Dragonfly Doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a power supply or resistance area. This illustrates a perfect Gravestone Doji. This pattern indicates that while buyers were able to push prices well above the open. Gravestone Doji is a bearish pattern that suggests a reversal followed by a downtrend in the price action. Gravestone pattern can be used as a sign to take profits on a bullish position or enter a bearish trade. The opposite of a Gravestone Doji is a Dragonfly Doji. The Morning Star. A morning star is a visual pattern consisting of 3 candlesticks that are interpreted as a bullish sign by technical analysts. It forms a following downward trend and it indicates the start of an upward climb. It is a sign of a reversal in the previous price trend. It is a visual pattern made up of a tall black candlestick, a smaller black or white candlestick with a short body and long wicks, and a third tall white candlestick. The middle candle of the morning star captures a moment of market indecision where the bears begin to give way to bulls. The third candle confirms the reversal and can mark a new uptrend. The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. The morning star pattern shows us how buyers took control of the market from sellers when this pattern occurs at the bottom of a downtrend near a support level. It is interpreted as a powerful trend reversal signal. The chart above helps us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produces indecision in the market. The second candle could be a doji or any other candle. But here, the doji candle indicated that sellers are struggling to push the market lower. The third bullish candle indicates that buyers took control from sellers, and the market is likely to reverse. This is how professional traders analyze the market based on candlestick patterns, and this is how you will analyze financial markets if you can master the anatomy of candlestick patterns and the psychology behind their formations. The Evening Star Pattern. The Evening Star Pattern is a bearish version of the Morning Star Pattern. When it occurs at the top of an uptrend, it indicates a chance of trend reversal. The pattern consists of 3 candlesticks. The first candle is a bullish candle. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlestick. The third candle is a large bearish candle. Following is an example of the Evening Star Pattern. The first candle in the evening star is a bullish candle, which indicates that buyers are more active in the market. After that, the formation of the small candle shows that the market is still in control of buyers but not active as they were. The third bearish candle describes that the sellers are taking control of the market, thus there is a chance of trend reversal. See another chart that illustrates how the evening star could represent a significant trend reversal signal. As you can see, the market was in an uptrend. The first candle in the pattern shows a long move up. The second one is a short candle, which indicates that the first bullish candle is losing its strength and there is indecision. The last one gives a confirmation of trend reversal as it is gaping down the previous candles. The hammer, Pinbar. It occurs when open high and close are nearly the same price. It passes a long lower shadow, which indicates that buyers are trying to push the market high over the sellers. When it occurs at the bottom of a downtrend, there is a chance of a trend reversal. It forms when after the markets open the seller pushes the market down but the buyers reject them, so the market closes at a higher price. In the above example, you can see that the market was in a downtrend, but after the formation of the pin bar, there was a significant trend reversal. It is because even though the sellers are pushing the market down, the buying pressure was dominant than the selling pressure at that level, which leads to a trend reversal. The shooting star, bearish pin bar. It is a bearish version of the pin bar when it occurs in an uptrend. There is a chance of bearish reversal. Formal when the open low and close are roughly the same. It passes a small body and long upper shadow. The psychology behind this pattern is that buyers try to take control of the market but they got rejected by selling pressure. In the above example, you can see that the market was in uptrend. After the formation of the shooting star, the trend reverses. A shooting star is very easy to identify and can be used as a powerful signal to enter the market. The Harami pattern, the inside bar. Harami in Japanese means pregnant. Harami is a two-candle pattern in which the first candle is usually a large candle and the second candle has a small body like a mother and child. If it occurs at an uptrend, bearish reversal. If it occurs at a downtrend, bullish reversal. In this pattern, you can see the smaller candle is fully covered by the mother candle. Color of the candle doesn't matter, the most important thing is smaller body closes inside of the first bigger candle. Harami patterns show that there's an indecision period. In the above example, you can see that at first, the market was in a downtrend. Therefore, sellers are dominant in the market when the bullish Harami patterns form. These faces a consolidation in market price and sellers are no longer in control of the market. And the bearish Harami pattern, which is formed at the top of an uptrend, indicates that the buyer's domination is over and there is a chance of trend reversal. Thus, Harami pattern shows the direction of the market. The tweezers tops and bottoms. It is a two candlesticks patterns in which tweezers top indicates a bearish reversal. Tweezers bottom indicates a bullish reversal. Tweezers top. The first candle is a bullish candle and the second is bearish. It occurs during an uptrend in which buyers are stronger in the market and it is going on. But surprisingly, sellers take control over buyers and push the market lower and close down the open of the bullish candle. Tweezers bottom. The first candle is bearish and the second one is bullish. It happens during a downtrend in which sellers are stronger in the market, but at the next moment, buyers take control of the market and price closes above or nearby at the same price of the first bearish candle. If the price action happens near a support level, there may be a bearish reversal. The above chart illustrates that the market was in a downtrend in the first session. After that, the second session opened at the close of the first session. And went upwards, gives a clear indication of a trend reversal. Don't by heart these patterns, try to understand the psychology behind its formation. By understanding the psychology, you can easily predict the future movement of the market and can achieve successful trades.
Subscribe to our channel to get daily trading contents and hit the bell icon for notifications.